Let's talk now with Hugh. Hugh, you're with Allworth's Money Matters.
Good afternoon. How you doing?
Good. How you doing, Hugh?
I'm doing good. Thanks for talking to me.
Yes. Glad you joined us. How can we be of assistance today?
I get an email from you regularly, and one of the more recent ones had a long list of services or opportunities that you provide. And near the end of that list was faith-based investing.
Yes.
I'm a do-it-yourself investor. I'm very fee sensitive, so I'm looking for ETFs and mutual funds with low expense ratios. I'd be happy to use a screening tool if it was available to me at a low cost. Those are things I'm interested in. What I'm doing right now is on my own, avoiding tobacco and alcohol and gambling and pornography and abortion. I don't necessarily think that's the perfect list for everyone. For me, it's a good start, and I'm doing that by using low-cost, sector-based funds primarily. What do you think about what I'm doing? What advice do you have or suggestions do you have for a do-it-yourself investor like me with this kind of objective?
Well, so the marketplace has evolved dramatically in the last few years when commissions went to zero on stock trades. And that was really driven by Robinhood, I think. And then Schwab and Fidelity followed suit. And so the major platforms now you can buy and sell stocks without any transactions.
And essentially forced TD Ameritrade into the arms of Charles Schwab.
That's exactly right. And they ended up merging. And this is how capitalism works, right? So, and so with that, there are strategies, instead of using sector ETFs, where you can build a broad index owning individual securities and then screen out those companies that you don't like.
So you have a no-hold list, right? So there's a list that says, okay, I would like to get as close to the S&P 500 as possible, but I never want to own Remington or
whatever,
or Coors. Or
and what I think is powerful about that, this approach, as opposed to, I mean, I know there's some funds out there that abide by some sort of, but look at how many different. Let's just took the majority of Americans would be under the Christian faith. So let's just look at that. All the different denominations. So one person might say, I don't think gay marriage is appropriate. Other people say, I don't have any problem with that. They could both under the faith-based thing. Some say, I'm completely opposed to capital punishment. Someone else says, I'm in favor of capital. I mean, the list is pretty long. So with a separately managed account, which is essentially how these are, and if you use an index tool, a direct index tool, each individual, each family can choose for themselves their convictions on their faith and build a portfolio that is designed specifically for them and have a very low cost and probably have much less risk than trying to pick out individual sectors.
Yes, I would agree with that. Because the sectors, you're still going to hold some of those stocks you don't want to own. I mean, the sectors are only so good.
Yeah, so if the question is, as an individual investor, a do-it-yourselfer, like what are some? I'm not an expert on what tools are available, but I would be highly confident that there would be a provider out there of a direct indexing, or it's a separately managed account that has a technology overlay to bring the cost really down. And instead of trying to pick individual securities, it tries to mimic an index. So it's
it used to, I helped write a request for a proposal for the Diocese of Sacramento for their endowment, and when we got through all of the gyrations, there was basically two companies that actually could do that. But that was 25 years ago. You could come to our company and we could do that today.
That's right.
It's easy. It's easy. So in terms of cost, I don't know, what are you paying for these sector funds?
0.09.
It's going to be more expensive than that.
Ratio.
Not 9 basis points. It'll be a little bit, but you'll have I think probably much less risk.
That's right. And you'll get closer to...
You'll have greater diversification. I can't imagine the things you're having to exclude out of sector funds.
Yeah. And you'll get closer to your what your true purpose is.
Right. So I'm sure you could do a better job of this than I am, and that the cost of the funds would be relatively comparable. The thing that I would see prohibitive for me using your services would be the assets under management. I assume that's in the neighborhood of 1% in general with whoever I'd be talking to. And for me, that's prohibitive.
Well, it depends on the account size, but if you find it prohibitive, then don't hire us.
Right. So I
Just
think what
take
you're
our
doing
advice
is
from
wonderful for a lot. Right. Wonderful for a lot of folks. I was just curious if you might guide me some in terms of what I'm doing. And I'd like a little more feedback from you, if you would, about sectors. That is, specifically thinking about the list that I've got that I'm
Yeah. So how in the world, I'm just trying, with your list, how do you pick the sectors? Or
you'd have to
So the
exclude.
sectors I've chosen.
Okay,
So
what
the
are
sectors
they?
I've chosen, and maybe I can get through the whole list. It's just 6 or 7.
All right, fire away.
And then you start picking them off after you've got the whole list of what I'm missing in thinking about these sectors. So technology, financial services, industrials, materials, utilities, energy, and that's all I've got is the base sectors. I've then also got a few things where I've kind of worked around the edges in some other areas.
Okay. I unless we took this thing and modeled it, I have no idea
I mean,
whether it looks like a total market or not.
I think about half the market.
Well, that's a big deal, right? Because you
Yes,
miss
it is.
consumer durables, consumer staples in there, right?
you're taking
Right.
way more risk than you need to be.
Yeah, where you could actually just, if you think about the thousands of companies out there, or even the S&P 500, you could probably achieve your objective by excluding 60% of those stocks, right? Depending upon how big your no-own list is. But the only way you're going to get there is actually you're going to have to use a third-party software overlay, which they charge for. And
I don't know.
what
we can get it for is probably not what he could pay.
That's right.
Because we get economies of scales. It's an institutional.
Yeah.
So there are some screening tools out there available to me, but they are, again, pretty expensive from my perspective.
Well, it depends on it depends on what's expensive. You just look at the cost versus the return.
Yeah.
Right? You're missing a large portions of the market. And I would say to you, listen, if it costs another 30 basis points, right? Then I would pay the 30 basis points for to get that.
Well, you've been doing this long enough. You know the value of someone working with a good advisor, and it pays for themselves.
All my children work with advisors, and they're just beginning their careers, right? My 4 children, each one of them works with them, and they don't have big accounts, but we do get a little bit of a discount, but we pay.
Are these held inside of retirement accounts or outside?
Inside.
Okay. So we don't have tax considerations.
Yeah. You should do a little bit more exploration because of what you're doing with the sector funds, right?
And by missing out on some value areas and that.
Yeah, right. You said tech, finance, energy. What were the other ones?
Materials, industrials. I'm doing some things with utilities, but not fundamentally through a fund. I am attempting to catch some healthcare and consumer stuff with individual stocks.
Okay,
a few dozen, which I know I lose incredible amounts of diversification when I start taking 10 or 12 individual stocks to represent some other stuff.
That's right.
You still have systematic risk that you've not diversified away.
Yes.
Sure.
Yeah, and so
I understand.
Look, and we're not. I would make an argument for using our firm, but in your particular case, you seem adamant not to use an advisor. Using the tool that you could directly purchase from a third party is not the same as using an advisor. Like the tools we use in our own company, the amount of software.
We pay a lot of money for those tools.
We pay a tremendous amount of money, and we pay
they work.
a lot of people to actually support those tools all the time. So you you keep talking about cost, right? And I'm telling you, yes, you're right. You should worry about cost, but you're worried about the wrong cost. You should worry about opportunity cost
and risk.
That's what you should worry about. So why don't you go out and you could back test this portfolio? You could take your portfolio and back test it against a model portfolio, excluding these.
Yeah, there's
particulars.
tools. You should be able to actually upload your statement electronically into a tool. It can screen exactly what your portfolio is. It can look at things such as what's the beta of this portfolio, which is how you measure risk and volatility relative to the S&P 500, the broad market. What is this beta? What's this look like in times of distress in the markets? How does this react as compared to the overall broad index? Then you can see what the cost is. Because in our opinion, then you might be taking on a lot of risk that you're not even being compensated for.
Oh, I know it. You're missing too much of the market. And that's because you're using sector funds. Look, if you called our show 10 years ago, we've been doing
Things
this
have
30
changed
years.
dramatically, even in the last 5 years.
Yeah, if we called 10 years ago, I'd say, yeah, that's probably the best solution for you. That's probably the best. It's not even close to the best now.
So I'd look at if I'd look at some screening tools, and I'd have a separately managed account where you've got several hundred different securities in there.
All righty.
Quick question for you.
Thank you very much.
Quick question for you, Hugh. How old are you?
Yes. I am 66. My wife is 68. The retirement accounts are fundamentally for long-term care, eventually for us if we need it, and for the lifetime needs of my adult disabled daughter. We are living on
Oh,
pension. There are survivor benefits that will apply to my wife and daughter as well, but potentially
So Hugh, all right. So this is you get hit by a truck today. What happens to this?
Where's the money go? Who's managing it?
So I've got two adult sons and a brother and a bunch of competent people in my world that will then make decisions that work for them. And they may go straight to you or to someone else and turn it all over to someone. And if that's what they need to do, I'm okay with that. I'm not concerned about that.
And you've had
my
that
lifetime. We've had that conversation.
Perfect.
But
Good.
not
Perfect.
as often. We need to do more of it. We've started that conversation. We've touched on it. It needs more detail. I know that's a big need. And as I'm just starting into retirement, we're working hard to address that more. And I greatly appreciate you calling my attention back to that.
Yeah, because that's the
biggest
big issue.
That is the biggest.
Yeah, particularly with an
adult disabled
where you need a special
child.
needs trust. You need someone.
And I assume that you've already actually sat down with an attorney to create a special needs trust at your death.
We have done that, and we have a will. As with most folks, that's not entirely good because that's in my brain. I'm saying that's approaching being out of date. More realistically, without bias, that probably is out of date and needs to be redone.
All right. Well, you're a realist.
Yep. Wish you well, Hugh.
Appreciate the call.
Yeah.
Thank you
calling.
very much. You've been very helpful.
All right. Good.